Right, let's have a look at our installment sale agreements. Two important changes. When you look at our lessor's records, most probably our lessor will receive a deposit on the transaction. Therefore, we will have to read the information and you will have to recognize the deposit. And then we can only recognize a finance lease. Therefore, this is the one difference. The second difference, our lessee will now be regarded as the owner of our asset. But guys, these differences have quite an impact on our tax. Let's have a look at this. Okay, now from your purchaser's perspective, which will now be our lessee, okay, we've identified that ownership will transfer of the asset. Now, when you think about the tax implication, guys, you need to be with me on this one. Our lessee in a normal lease transaction will not be the owner. Then you will remember, for tax purposes, your current tax calculation, you will have to obtain your profit before tax, rule 1, rule 2. Take out your accounting, and we have determined that this is the depreciation and this will be the interest that we need to take out, add back. And then the standard indicates to us that we may deduct the full payment. Okay, this is when we have a normal lease transaction. Now, our lessee is the owner of this asset. Therefore, yes, our lessee is now the owner. And we need to take this one step further. If, and this is the if, the asset is used to produce taxable supplies. Therefore, you need to ask yourself this question. If used to produce taxable supplies, and your answer is yes. Back to basics again, guys. Think about your current tax calculation. We need to take out our accounting rules and in with our tax rules. Now, in a normal lease transaction, no installment sale agreement, we have identified that our accounting rules will be our depreciation and our interest. In a normal transaction, we have identified that we may deduct our full payment. Now they indicate to us, in an installment sale agreement, guys, are you with me on this? This is now the owner, and yes, the asset is used to supply taxable goods. We may now, and I'm going to delete this, guys, okay? Look at the left side of your screen. If we need to take out our accounting rules, we need to take out our depreciation on the right of use of our asset. Yes. Guys, do we take out our finance? No. The finance costs in accordance with the Income Tax Act are deductible as they are incurred. Do you see, guys? Therefore, we will not take out, I'm going to indicate not take out your finance costs. Do not take this out. You only take out your depreciation. And then, in terms of our tax rules, guys, we will now receive a tax allowance. Therefore, you need to read and you will have to deduct your tax allowance. Okay, you see the difference? And think about the implication in terms of your deferred tax calculation for me as well. Let's look at this now from our seller's perspective, our lessor. You will identify, I've included our journals in terms of our finance lease on the right side of your screen. Okay, so we have identified operating lease not applicable anymore. For accounting purposes, this will be treated the same as per our finance leases, therefore the same journal entries. The only difference, there will be a profit or loss recognized on this transaction, and this will then be included in our profit and loss statement. Then when you look at this for tax purposes, remember, for tax purposes, our lessor will now not be the owner, our lessee will be the owner, and our lessor, remember when you think about your current tax calculation, we need to take out our accounting rules. Therefore, our owner of this asset for tax purposes is our lessee. But still for accounting purposes, guys, is this still the owner? No. Why not? Because we've already credited our asset when you look at your journal entry. Therefore, nothing, guys. From a tax point of view, when we need to include our tax, remember now for tax, the finance income is already included in our profit before tax. Therefore, we will need to be taxed on this. We don't include anything. But when we look at Section 24, Section 24 of the income tax stipulates that the profit, which is your sales less cost of sales, is deemed to accrue to the seller irrespective of whether the amount is received in cash or not. However, under certain circumstances, an allowance for amounts not yet received by the seller is provided by allowing a deduction equal to, now don't look at the calculation for me for now, by allowing a deduction equal to, when you look at our calculation right side of your screen, in year 1, normal principles, current tax, determine profit before tax, profit and loss statement, take out accounting, include your tax. Now they indicate to us that they will allow a deduction in terms of Section 24, and you are able to read the calculation formula for me. Okay, and then they indicate to us in the following year, when the actual profit is calculated, we may add back this deduction calculated in year 1. Okay, now let's have a look at our implication on our deferred tax. Remember, when you look at this now from the perspective of our lessee will now be our owner. Therefore, the main difference, guys, the main difference is that we will now include a tax base. You have already included your carrying amount of your right of use of your asset, but now we are able to calculate our tax base. When you look at this from the perspective of our lessor, not the owner, and we only include our net investment. Okay, included a summary below. Again, guys, you need to work through this. You need to know the principles. In terms of presentation and disclosure, I want you to please read through the paragraphs on your own. I will spend some time at the end of the recording in terms of our templates.